Hello, this is Japanese Economic Review Channel. Welcome to today's deep dive.
Yeah, thanks for having me.
So if you're actively managing capital or really just watching the markets right now, keeping up with global finance can feel a bit like, well, drinking from a fire hose.
Oh, absolutely. It's a lot to process right now.
It really is. So today our mission is to unpack the newly published Domestic Weekly Market Outlook. We're looking at the publicly released statistics for the week of July 13th to July 17th, 2026.
Right. And there's a lot of data in this report.
There is. And we want to cut through those dense numbers to decode the three massive macro forces colliding in the market right now. We're talking about the AI tech boom, the geopolitical shockwaves coming from the Middle East, and, of course, this historic currency tug of war.
Yeah, those three pillars are really dictating everything.
Exactly. Because we want you, the listener, to understand not just what the numbers are, but why they actually matter to your own financial reality.
And, setting the scene here, the current numbers from the report are pretty staggering.
Oh, for sure. I mean, we have the Nikkei 225 closing at 68,557.73. That's down over 11,186 points for the week.
Which is just a massive drop.
It really is. And the DPI is sitting at 4,036.08. But maybe the most intense figure right now is the USD to GPY exchange rate, which is hovering right at 161.79.
That exchange rate is just wild. But let's start with that biggest question on the board, right? The Nikkei drop.
Yeah.
Because why did it drop so much, and why didn't it just crash completely?
Right. So the SBI report points out something really fascinating. The plunge wasn't actually driven by a panic over fundamental company values.
Okay, so what was it?
It was mostly index-linked ETS sell-offs. But the reason it didn't completely crash is that the AI sector basically acted as this massive shock absorber for the rest of the market.
Oh, wow. So AI stocks held firm while everything else dropped.
Exactly. The ETF sell-offs drag everything down blindly.
Right.
When huge funds liquidate, they don't cherry-pick. They sell a proportional slice of everything in the index. So it's like a massive commercial fishing net. The algorithm just says sell, and it drags up everything. Good stocks, bad stocks, whatever.
That's a perfect way to look at it. It's a purely mechanical selling wave. But despite that indiscriminate pressure, the AI-related semiconductor stocks barely flinched.
They're like the load-bearing walls of a skyscraper right now. If they wobble, the whole building shakes.
Yeah, and because they held up, the SBI report is actually predicting a Nikkei range of 66,000 to 70,500 for this week.
So the hope of a 70,000-point recovery is still alive.
It is, but there's heavy resistance around that 70,000 mark. And the report warns we could see a 5% volatility swing depending on a few major catalysts hitting this week.
Right, and we have some huge ones coming up, like Taiwan's TSMC announcing Q2 earnings on July 16th.
Yes, and they also have their delayed June sales coming out on July 13th.
And that delay was just physical, right?
Yeah.
A typhoon pushed it back.
Yeah, exactly. Extreme weather-disrupted operations. But beyond TSMC, we also have ASML Holdings in the Netherlands announcing earnings on July 15th.
The reliance on ASML is always amazing to me. For anyone listening who might not know, ASML has a literal global monopoly on extreme ultraviolet lithography machines.
Right, the EUV machines.
Yeah, they're like the size of a city bus,
Yeah.
and they use lasers to blast molten tin to print circuits a few atoms wide.
Mm.
You physically cannot make these new AI chips without them.
No, you can't. Which leads into the absolute biggest focal point for TSMC this week. The market isn't just looking at their raw revenue. They are laser-focused on the yield rate of NVIDIA's new Rubin AI semiconductor.
Okay, wait, let's break that down. Because I look at the demand for AI chips and, companies are just begging for compute power.
Oh, absolutely. The demand is off the charts.
Right. So wouldn't buyers just take whatever TSMC can produce? Like, isn't the yield rate secondary as long as the volume is high?
Well, that assumes the chips they produce actually function.
Oh, I see.
Yeah, at the microscopic scale of this new Rubin architecture, the transistors are so small that quantum physics literally starts interfering with the electrical currents. So the process is incredibly sensitive. A tiny vibration or temperature shift can ruin the chip. The yield rate is simply the percentage of chips on a silicon wafer that work versus the ones you have to throw in the trash.
So if TSMC is throwing away like 40% of a wafer because it's too hard to print, their margins just collapse.
Exactly. And the global market is basically pricing in perfection right now. If TSMC reports even slightly disappointing yields on the Rubin chips, it signals a major bottleneck.
Meaning NVIDIA gets fewer chips, the tech giants get fewer servers, and the whole AI rollout slows down.
Right. And if the semiconductor sector dips, since it's the only load-bearing wall keeping the market up, that's what triggers that 5% downside risk the report warns about.
Diversification really is crucial right now,
Mhm.
which transitions us to the second macro force. Because if AI is holding the market up, what is actively dragging the traditional economy down?
Well, the traditional economy, like retail and construction, is facing some severe headwinds. The IMF actually just downgraded Japan's economic growth forecast.
Yeah, the rotation of capital into non-AI stocks has basically stalled completely, right?
It has. And the SBI report ties that stall directly to resurfacing geopolitical risks in the Middle East.
Now, before we dig into the specifics of this, we need to be totally clear with you, the listener.
Hmm.
The published reports we're looking at contain some politically charged content regarding the U.S., Iran, and the Trump administration.
Right.
And we are not taking any political sides here. We're just impartially reporting on the public data and events to understand the economic cause and effect.
Exactly. So, strictly looking at the economic chain of events, we've seen a rapid escalation. Iran attacked a merchant ship, and the U.S. retaliated by bombing Iranian military facilities.
And then the U.S. revoked Iran's oil sales license, right?
Yes, and mechanically, that puts immediate, intense upward pressure on global crude oil prices.
But the report also notes that U.S. President Trump has officially stated this won't lead to a resumption of full-scale combat.
Right, he did state that.
So if the U.S. is officially saying no full-scale war, why is the market still so spooked? Why does tension in the Strait of Hormuz physically stop investors from putting money into, say, Japanese retail?
Well, it comes down to Japan's domestic supply chain. Japan is heavily dependent on imported energy.
Right.
So whether a full war breaks out or not, tension in that specific strait, plus the U.S. revoking Iran's oil license, drives up global oil prices.
Because it's the most critical choke point for crude oil.
Exactly. High oil prices absolutely crush the profit margins of domestic Japanese retail and construction firms.
Because their logistics, their raw materials, their power, it all runs on imported energy.
Great. And so until the strait normalizes, investors are just going to seek the perceived safety of AI. It leaves the broader economy completely starved for capital.
And speaking of things crushing domestic profit margins, we have to talk about the currency battlefield.
Oh, yeah. The yen versus the dollar.
Because this tug of war is directly influenced by those exact oil prices we just talked about.
Yeah, the USD to JPY hit a 39.5-year high for dollar strength on July 1st.
Which is just historic. And the report expects a trading range of 159.50 to 164.0 for this week.
Right. The dollar spiked largely because the U.S. revoked that Iranian oil license. It drove up oil, which stokes U.S. inflation fears, which strengthens the dollar.
But it was capped, right? It didn't just fly past 164.
No, it was capped by the limited nature of the military clash, but also by deep fears of Japanese currency intervention.
Yeah, Japanese Finance Minister Satsuki Katayama actually sparked some yen buying by indicating support for domestic financial investments.
She did. And she's pushing to revise the Hanabudo, the basic policy on economic and fiscal management, to explicitly include checks on Bank of Japan rate hikes.
Wait, let's unpack that. Because if the yen is historically weak, and that makes imported oils super expensive, shouldn't the BOJ want to hike rates to strengthen the currency?
You would think so, but raising rates also makes borrowing much more expensive for domestic businesses and consumers. With the IMF downgrading growth, a rate hike could really hurt the domestic economy. So it's a massive, high-stakes tug-of-war. On one side, high oil and the U.S. economy are pulling the dollar up toward 164. On the other side, Minister Katayama and the BOJ intervention threat are pulling the yen back down.
Right.
So who actually has the leverage here?
Well, the true tiebreaker won't just be Katayama's domestic policies. It's actually going to be what happens in the U.S.
Right, because we have critical U.S. data dropping.
Exactly. We have the U.S. CPI on July 14th, the PPI on the 15th, and the Beige Book on the 15th.
But the crucial event is Fed Chair Warsh testifying before the House Financial Services Committee on the 14th and 15th.
Yeah, that testimony is everything. And why Fed President Williams recently struck a really optimistic tone on inflation cooling.
Right.
So if Warsh echoes that and hints inflation is cooling, the dollar's momentum could break.
But if inflation remains hot because of the oil shock, and Warsh is hawkish,
Then that psychological 164 yen barrier is going to be severely tested. Wow. So bringing this all back to you, the listener, whether you're actively trading semiconductor stocks or just buying groceries that are affected by the weak yen or watching your pension fund,
yeah, it all connects.
these three pillars, TSMC's chip yields, the Strait of Hormuz, and Fed Chair Warsh's words, they are actively shaping your wealth this week.
They absolutely are. And, I want to leave you with a larger philosophical question to mull over.
Okay, what is it?
If AI is the primary life raft keeping global markets afloat right now amidst downgraded growth, high oil prices, and all this geopolitical chaos, what actually happens to the global economy when the AI innovation cycle eventually matures and normalizes?
Oh, wow.
Like, are we building our financial future on a permanent shift, or is this just a temporary tech buffer?
That is a phenomenal question to think about, because eventually every sprint turns into a jog.
Exactly.
Well, thank you for watching the Japanese Economic Review. We look forward to having you with us again.